What if I told you that while everyone was panicking about silver crashing to $71, a completely different story was unfolding behind the scenes? A story that explains why silver just reclaimed $90 per ounce in the last 60 minutes. A story that has nothing to do with charts, technical analysis, or even the usual suspects of monetary policy. This is about a trade deal that just fundamentally altered the supply and demand equation for silver. And if you're holding physical silver or you're thinking about entering this market, the next 15 minutes could change how you view this entire asset class. Let's dive in. On February 3rd and 4th, 2026, two leaders announced a trade agreement that sent shockwaves through commodity markets. But here's what's fascinating. The mainstream financial media barely connected the dots to silver. They talked about tariffs, they talked about energy, they talked about trade deficits. But they missed the elephant in the room. India is the world's largest consumer of silver, not just a major player, the largest. And for the past several months, Indian demand has been essentially locked out of global markets due to punitive tariffs that made importing silver-intensive goods economically impossible. Those tariffs just got slashed by more than 70%. In the last hour, the silver market has begun to price in what this actually means. And the volatility you're seeing, it's just the beginning. Let me give you the numbers that matter. Before this deal, the United States had imposed a 50% tariff on Indian goods. 50%. This wasn't a normal trade policy adjustment. This was punitive. It was designed to pressure India on specific geopolitical issues, particularly around energy procurement choices. For Indian manufacturers, especially in the jewelry, electronics, and solar sectors, this was devastating. These industries are massively silver-intensive. When you're trying to export jewelry to the United States and you're facing a 50% tariff on top of your production costs, your margins don't just shrink. They evaporate completely. The data backs this up. Indian jewelry exports to the United States dropped 60% during the high tariff period. 60%. That's not a slowdown, that's a collapse. Now here's where it gets interesting for silver holders. This new deal cuts those tariffs from 50% down to 18%. That's a 74% reduction in the tariff burden, and it's effective immediately. What does this mean in practical terms? Indian manufacturers who have been sitting on the sidelines for months, unable to compete in the American market, can now profitably export again. But there's a problem. Their inventory is depleted, their supply chains are empty. They haven't been buying silver because there was no point in building inventory for a market they couldn't access. That's about to change dramatically. Let's talk about the scale of Indian silver consumption. India doesn't just use silver for jewelry, although that's a massive component. India is also becoming a powerhouse in solar panel manufacturing and electronics production. Both of these industries are incredibly silver intensive. A single solar panel uses approximately 20 grams of silver. India has been aggressively expanding its solar manufacturing capacity as part of its energy transition strategy. With the tariff barrier removed, Indian solar manufacturers can now competitively export to the United States, which is the world's second largest solar market. The electronics sector tells a similar story. Silver is essential for circuit boards, switches, and conductive components. Indian electronics manufacturers have been building capacity but haven't been able to fully leverage the American market due to the tariff wall. Now think about the restocking wave that's coming. These manufacturers need to rebuild inventory immediately to capitalize on the new market access. We're not talking about a gradual increase in silver demand. We're talking about a compressed buying cycle where months of pent-up demand hits the market simultaneously. Industry analysts are projecting a 20 to 30% increase in Indian industrial silver demand over the next quarter. That's not speculative. That's based on order books and manufacturing schedules that are already being adjusted. But here's the kicker. The silver market is relatively small compared to other commodities. Total annual silver production is around 1 billion ounces. A sudden 20 to 30% demand spike from the world's largest consumer, that's a market-moving event. Now let's talk about what happened in the last 24 hours that most Western traders completely missed. The trade deal was announced during Indian trading hours. The Multi-Commodity Exchange of India, known as MCX, was open and actively trading when the news broke. Silver on the MCX absolutely exploded. We saw a 14% single-session gain, with prices hitting nearly 2,84,000 rupees per kilogram. That's roughly $105 per ounce when you do the conversion. Here's the problem. The COMEX, the dominant silver exchange in the West, was closed when this happened. When COMEX reopened, there was a massive price discrepancy. Indian silver was trading at a significant premium to Western silver. This created an arbitrage opportunity that sophisticated traders immediately started exploiting, but it also created something more dangerous, a credibility crisis for paper silver pricing. Think about it. If physical silver in India is commanding a 14% premium in a single session based on fundamental demand changes, but paper silver on the COMEX is still pricing in the crash narrative from earlier this week, which price is real? In the last 60 minutes, we've seen Western silver prices spike as traders scramble to close this arbitrage gap. The COMEX is playing catch-up to a reality that the Indian market already priced in. This is why you're seeing such violent volatility. The market is trying to reconcile two completely different pricing regimes. But there's another layer to this. The CME Group, which operates the COMEX, raised margin requirements on silver contracts earlier this week. This was done in response to the previous volatility when silver crashed from over $100 down to $71. Higher margin requirements mean traders need more capital to maintain their positions. For traders who were short silver, betting that the crash would continue, this margin hike created a liquidity crunch. As silver started spiking on the India news, these short sellers faced margin calls. A margin call means you either need to deposit more money to maintain your position, or your position gets liquidated automatically. In the last hour, we've seen clear evidence of forced liquidation. Short sellers who thought silver was heading to $60 suddenly found themselves underwater as prices rocketed back above 90. This is a classic short squeeze, and it's being amplified by the fundamental demand story coming out of India. Here's where the narrative shift becomes critical for understanding where silver goes from here. For the past several years, silver has been caught in a strange identity crisis. Is it a monetary metal like gold, or is it an industrial commodity like copper? The answer is both, and that's what makes silver unique. But the ratio of safe haven demand versus industrial demand has been shifting. When trade tensions were high, when tariffs were escalating, silver benefited from safe haven flows. Investors bought silver as a hedge against economic instability. But that demand is psychological. It's based on fear. What this trade deal represents is a fundamental shift from fear-based demand to growth-based demand. The reduction in trade tensions between two of the world's largest economies is being interpreted as a de-escalation. That reduces safe haven demand, but simultaneously it massively increases industrial demand. By opening up trade channels, by reducing friction in the supply chain, you're enabling higher manufacturing output, and higher manufacturing output means higher silver consumption. This is why some analysts are calling this the transition from silver as money to silver as industrial powerhouse. The demand driver is changing, but the demand itself isn't disappearing. It's actually increasing. Consider the broader implications. If trade barriers come down, global manufacturing becomes more efficient. Solar panel production accelerates. Electric vehicle production accelerates. Electronics production accelerates. All of these industries consume massive amounts of silver. The trade deal isn't just about India and the United States. It's a signal that trade policy might be moving toward cooperation rather than confrontation. If that trend continues, the industrial demand case for silver becomes even stronger. Now we need to talk about the elephant in the room that this entire situation has highlighted: the disconnect between physical silver and paper silver. Even as COMEX prices crashed to $71 earlier this week, physical silver dealers were completely sold out. Premiums on physical coins and bars spiked to $50, $60, even $80 over spot. You had a situation where paper silver was saying the market was collapsing, but physical silver was saying the exact opposite. The India situation amplifies this disconnect. When the MCX jumped 14% and Western exchanges lagged, it exposed the fact that regional physical demand can completely override paper pricing mechanisms. Here's what this means for you as a silver holder or potential buyer. If you're holding physical silver, you're holding an asset that has real, tangible industrial demand. That demand just got significantly stronger due to this trade deal. The paper price volatility you're seeing, that's derivative markets trying to adjust to a new fundamental reality. If you're thinking about buying silver, you need to understand that physical premiums are likely to remain elevated, or even increase as Indian manufacturers start their restocking cycle. The days of buying physical silver at spot price are probably over for the foreseeable future. The arbitrage gap between regions also tells you something important. Silver is a global commodity, but it's not uniformly distributed, and demand is highly concentrated in specific regions. When one of those high-demand regions suddenly gets unrestricted market access, it creates supply pressure everywhere else. So let's tie this all together. In the last 60 minutes, silver reclaimed $90 per ounce. This wasn't random. This wasn't technical analysis playing out. This was the market beginning to price in a fundamental demand shock. The trade deal between the United States and India cut tariffs by more than 70%. This unleashes the world's largest silver consumer back into global markets after months of being sidelined. Indian manufacturers need to restock inventory immediately to capitalize on their new market access. That means a compressed buying cycle hitting a relatively small commodity market. The MCX already priced in a 14% gain. The COMEX is playing catch-up. Short sellers are being squeezed by margin calls. And the broader narrative is shifting from silver as a fear hedge to silver as an industrial growth play. The next resistance level is $94.88 per ounce. If Indian buying accelerates as expected, we could see that level tested within days, not weeks. But beyond the short-term price action, what this trade deal represents is a fundamental rewiring of global silver demand dynamics. The industrial use case for silver just got significantly stronger, and in a market where annual production is only around 1 billion ounces, demand shocks matter. So the question isn't whether this trade deal affects silver. The question is whether the market has fully priced in the magnitude of the demand shift. Based on what we're seeing in the physical market versus the paper market, based on the arbitrage gaps between exchanges, based on the inventory levels at manufacturers, the answer is probably not yet. This is a story that's still unfolding, and if you're paying attention to silver, this is the narrative you need to be watching. Because while everyone else is focused on yesterday's crash, the smart money is looking at tomorrow's demand explosion. That's the secret connection between the trade deal and today's silver volatility, and now you know what the market is really pricing in.